Welcome back to the Deep Dive. We're here to break down the complex stuff, making sense of regulations and finance for you. Today, we're tackling something pretty significant. The Reserve Bank of India's big update, their consolidated directions on lending against gold and silver. These kick in September 29, 2025. Our mission: to really dig into these rules, understand this shift towards principles over specifics, better consumer protection, and clearing up those old inconsistencies between different lenders.
Exactly. And it's important to remember the background here. For years, maybe decades, the rules were all over the place. Commercial banks did things one way, NBFCs especially, the gold loan specialists another, co-op banks yet another way. The basic idea, letting people use their idle gold or silver for quick cash, that was always there. But the rules on risk, transparency, very fragmented.
So this new document is basically one rule book to rule them all.
Pretty much. It creates this single mandatory framework, and compliance is required by April 1st, 2026. So lenders have a bit of time, but not much.
Okay, so who's actually caught in this net? Is it just the big players, or?
Yeah. Oh, it's wide, really wide. All commercial banks, that includes small finance banks, regional rural banks, but not payments banks, and importantly, all types of cooperative banks, urban, state, central, they're all in. Plus, of course, all non-banking financial companies and BFCs, and that now explicitly includes housing finance companies too.
Wow. So if you lend against gold or silver, you're covered. No exceptions.
That's the message. Nationwide harmonization.
All right, let's start at the beginning then. What kind of collateral are we actually talking about? Maybe more importantly, what's off limits? The RBI seems keen on preventing speculation, right?
Absolutely. That's a core principle here. These loans are meant for genuine short-term liquidity needs for households. They're not meant to fuel the gold market itself. So the directions are crystal clear.
Yeah.
You cannot get a loan to buy more gold. Doesn't matter if it's bullion, jewelry, coins, no buying gold with a gold loan.
Okay, that makes sense.
And second, you also can't use the loan to buy financial assets backed by gold. Things like, gold ETFs or those gold mutual funds. The loan has to be against physical gold or silver you already possess.
And the definition of that eligible collateral is quite specific too, isn't it? Focusing on personal items.
Correct. Eligible collateral is defined strictly as jewelry, ornaments, or coins made of gold or silver. Things like primary gold, bullion bars or silver ingots, that's prohibited. It's about unlocking value in household assets, not financing bullion dealers.
Now, this is interesting. They've put actual weight limits on the collateral per borrower. That feels very specific, almost granular. Why?
It tells you they're worried about scale. They want to prevent these loans being used for large-scale hoarding or maybe even financing small businesses under the guise of a personal loan. The limits are quite revealing. For gold ornaments, maximum 1 kilogram per borrower across all loans.
1 kilo, okay.
For silver ornaments, it's higher, 10 kilograms. But then look at coins, gold coins, capped at just 50 grams.
50 grams. That's tiny compared to the kilo for ornaments.
Right, and silver coins are capped at 500 grams. It sends a very clear signal.
So family jewelry, maybe inherited pieces, that fits the 1 kilo limit. But using this route to get cash against a stack of gold coins you bought as an investment, they're actively discouraging that with that low 50-gram cap.
Precisely. It's a macro-prudential measure, keeping these loans anchored in genuine household finance, not investment finance.
Okay, so we know what collateral works and what doesn't. Let's get into the numbers. How much can you actually borrow against it? The loan-to-value ratio, the LTV, that's changed significantly, hasn't it? No more single flat rate?
Correct. This is a major shift, particularly for what they call consumption loans, loans not directly for business or agriculture. The LTV isn't just set once, it has to be maintained throughout the loan. And crucially, it's now tiered based on the loan amount.
Tiered. Okay, how does that work? Break down those tiers for us.
Right, so there are 3 levels. For smaller loans, where the total amount is 2.5 lakh or less, the maximum LTV is 85%.
85%, that's quite high leverage.
It is, likely aimed at those very immediate small-scale household needs, medical emergency, school fees, that kind of thing. Then, if the total loan amount is bigger, say between 2.5 lakh and 5 lakh, the maximum LTV drops to 80%.
Okay, a step down.
And for any loan amount over 5 lakh, the LTV goes down again to a maximum of 75%.
So the bigger the loan, the less leverage you get, the more skin the borrower has to have in the game, effectively.
Exactly. It's the RBI building in bigger safety buffers for larger consumption loans, which they presumably see as potentially riskier.
Smart. Now, before we leave LPV, there's a mention of bullet repayment loans. Can you remind us what that means and why the RBI is setting rules around it?
Sure, a bullet repayment loan is simple. You pay nothing back, principal or interest, until the very end of the loan term. Then you pay it all back in one lump sum, one bullet payment. They're popular for short-term needs. But the RBI has now capped the maximum tenor for these consumption bullet loans at 12 months.
Only a year.
Only a year. And if you want to renew it after 12 months, you must pay off all the interest that's accrued first. You can't just roll it over indefinitely.
Right, preventing it from becoming a kind of never-ending debt trap.
That seems to be the goal. Keep it truly short-term.
Okay, let's talk about assessing the gold itself. Valuation. This seems like another area where they've really tightened things up to ensure fairness and prevent, well, manipulation.
Absolutely critical for trust. The rules state the valuation must be based only on the intrinsic value of the gold or silver content. So if your necklace has diamonds or emeralds embedded in it, they count for 0 in the loan valuation. Only the metal matters.
And they've taken away the lender's ability to pick a favorable price date too, haven't they? How does the reference price calculation work?
Yes, this prevents gaming the system. Lenders can't just use yesterday's spot price if it was unusually high or low. They have to calculate the reference price using the lower of two figures, either the average closing price for that specific purity over the last 30 days,
Okay, a 30-day average.
or the closing price from the single preceding day. Whichever of those two is lower, that's the price they must use for valuation.
So the borrower generally benefits from the stability of the 30-day average. Unless there was a very recent sharp drop in price, it smooths out volatility.
Exactly. It's designed to be conservative and fair, and the source for these prices is mandated too.
Where do they have to get the prices from?
It has to be either the India Bullion and Jewelers Association, LTD, the IBJA, or a SEBI-regulated commodity exchange. No wiggle room there. Standardized data source for everyone.
Right, standardization seems to be the theme. Let's shift to the human element, the interaction between the lender and borrower, the conduct-related aspects. This feels like the core of the consumer protection push.
It really is. And one of the standout rules here is about the assaying process checking the purity and weight. Lenders need a standard procedure, same across all branches.
Wow.
But the crucial part, the borrower must be physically present during the assaying when the loan is being sanctioned.
Wow, okay. So no more dropping off your jewelry, coming back later to find out the value. You watch them test it.
Precisely. It builds transparency right into the process. You see what they're doing. And linked to that, any deductions they make, say for stones that need removing, or if there's wax filling or fastenings, they have to explain those deductions clearly to you.
And then document it all.
Yes. Immediately after, the lender has to give the borrower a certificate, can be physical or electronic, but it has to be in duplicate. And this certificate details everything. The purity in carats, the gross weight, the net weight of the actual gold or silver, the specific deductions made, any notes on damage or defects, and the final calculated collateral value. Borrower gets a copy on the spot.
That's thorough. What about ensuring people understand the terms, especially vulnerable borrowers?
Good point. The loan terms and conditions must be communicated clearly, and importantly, in the regional language or another language the borrower actually chooses and understands. And there's a specific safeguard for illiterate borrowers. If someone can't read, the key terms have to be explained verbally, but it must be done in the presence of a witness.
A witness.
Yes, and crucially, that witness cannot be an employee of the lender. It has to be an independent third party, ensuring the explanation is fair and understood.
That's a strong protection against misunderstanding or mis-selling. They also mandate proper credit assessment for larger loans, right?
They do. For any loan where the total amount exceeds 2.5 lakh, a detailed credit assessment, including checking the borrower's repayment capacity, is now mandatory. It's not just about the collateral value for bigger tickets.
Okay, so that covers the loan setup. What happens if things go wrong? Default and auction. This is often where consumers feel most vulnerable. What new safeguards are in place here?
Transparency is the key word again. If collateral has to be auctioned, the lender can't just do it quietly. They have to make a public announcement in at least 2 newspapers. One has to be in the regional language, circulated where the borrower lives, and the other needs to be a national daily newspaper.
Wide publicity. And they can't just sell it off cheap to recover their money quickly. There's a floor price.
A very important one. The reserve price for the option, the minimum bid they'll accept, cannot be less than 90% of the current market value of that collateral.
90%? That's high.
It is. It really protects the borrower's equity in the asset. Only if the first 2 attempts at auction fail at that 90% level are they allowed to lower the reserve price.
And even then?
Even then, it can't go below 85% of the current value. So there's a strong floor.
That seems very pro-borrower. Does it risk auctions failing more often, though, if the floor is that high?
That's the potential trade-off, yes. The RBI is clearly prioritizing protecting the borrower's asset value over ensuring a quick sale for the lender. It might mean more failed auctions, potentially. And another fairness measure, the first auction attempt must be conducted physically in the same district as the branch where the loan was taken out.
Keeps it local and accessible for the borrower, potentially.
Right. Only if that first physical auction fails can they then consider online auctions or auctions in adjoining districts for subsequent attempts. Oh, and a conflict of interest rule, too.
What's that?
The lender itself, or any related parties like subsidiaries, directors, their families, they are strictly forbidden from bidding in the auction, prevents them from buying the collateral back cheaply.
Okay, that makes sense.
Yeah.
Now, let's talk about the best-case scenario after repayment, or even after a successful auction. Getting the collateral back or getting any surplus cash, this is where that huge penalty comes in, right?
This is arguably the rule with the most teeth. Once the loan is fully repaid, the lender must release the pledged collateral. The deadline, same day is ideal, but the absolute maximum is 7 working days.
7 working days. That sounds reasonable. But what if they don't meet it? What is that penalty?
Okay, brace yourself. If the delay in returning the collateral beyond those 7 working days is the lender's fault, they have to pay the borrower compensation of 5,000 rupees per day.
5,000 rupees per day of delay.
Per day. It's not a slap on the wrist. It's a significant financial deterrent.
Yeah.
The RBI is basically saying give people their property back immediately, no excuses.
That is extraordinary. It completely changes the power dynamic around collateral return. No more waiting weeks for paperwork to clear.
It sends a powerful message about accountability, and this applies to auction surplus too. If the auction fetches more than what was owed, that surplus amount has to be refunded to the borrower within 7 working days of the lender receiving the full auction proceeds.
Same promptness expected. What about damage or loss while the lender holds the collateral?
The lender is on the hook. If the jewelry or ornament is damaged during the loan period, the lender has to bear the cost of repair. And if there's outright loss or some discrepancy found later in the weight or purity compared to what was documented, the directions say the lender must suitably compensate the borrower. The onus is on them to safeguard the asset properly.
Okay, one last practical point. What if someone pays off the loan but just disappears?
Yeah.
Never comes back for their gold.
It happens. Maybe they move, maybe they pass away. The rule now defines collateral as unclaimed if it's left with the lender for 2 full years after the loan was fully repaid. In such cases, lenders can't just absorb it. They are now required to conduct periodic special drives to actively try and trace the borrower or their legal heirs to return the unclaimed collateral.
So a proactive duty to return it, even years later.
Yes, it remains the borrower's property.
This has been incredibly illuminating. We've covered a huge amount. The big themes seem to be harmonization across all lenders, finally getting banks and NBFCs on the same page, this new risk-sensitive tiered LTV system, especially for consumption loans, and just a raft of really strong pro-consumer rules around transparency, the assaying process, the documentation, the auction rules, and especially that massive penalty for delays in returning collateral.
Absolutely. And stepping back, you realize this single document repeals dozens and dozens of older circulars, some dating back to the 1960s. It's a massive regulatory overhaul. It's about modernizing, boosting consumer trust, managing those broader economic risks associated with gold, but still ensuring people can access liquidity when they need it against their assets.
It's a huge balancing act. So we leave you, our listener, with this final thought to chew on. We've seen how these incredibly detailed rules standardize everything from you being present during the purity check to that $5,000 a day penalty. Does this intense standardization, this level playing field, truly benefit the borrower most by ensuring fairness everywhere? Or could it, perhaps unintentionally, squeeze out the nimbler, specialized gold loan companies whose edge was speed and maybe slightly different processes, potentially reducing consumer choice in the long run? Does standardization always equal the best outcome for everyone? Something to think about. That's all for this deep dive.